Hello there, and welcome to the Look Ahead with me, Fiona Stincotta, Senior Market Analyst at City Index. We'll be looking ahead to the week starting the 17th of February. So just before we get going, I'm just going to ask you to take a look through the risk warning. I'll put myself on mute whilst you do that. Excellent. So let's crack on. I mean, what a week we've had this week. It's been quite interesting as far as news flow is concerned. And so I think, it's just worth talking about sort of key themes and where we stand before we look at the coming week, particularly with respect to what this sort of means for US equities and also the US dollar. Obviously, this week we've learned a lot about more tariffs coming into play, 25% tariffs on all steel and aluminium imports into the US. That's coming into effect as from the 4th of March. There's also been sweeping reciprocal tariffs have been announced by Trump just yesterday. And these will be delayed in their implementation, which I think has actually given the market some clues that maybe this is a negotiating tactic rather than a desire to put all-out tariffs across the board. So the fact that we got news of those tariffs and the market rallied, it's because of that delayed implementation, which has just sort of faded sort of globe war fears, if you like. Also last week, this week, we found out that US inflation is hotter than expected. And also wholesale inflation, so PPI, was also hotter than expected. So a lot of challenges there for the Federal Reserve. Jerome Powell spoke on 2 occasions. He testified before Congress, basically just reconfirming what we already knew, that the Fed is in no rush to start cutting interest rates, which stands to reason given that inflation is at 3% above the 2% target. And given that the US economy is still strong, not showing too many signs of weakness at all. So, there's nothing there to be giving the signs that the Fed should be cutting, particularly if there are also these concerns about what potential impact trade tariffs might have on the inflation level in the US. So this is the NASDAQ that we're looking at here. We can see that it's trading just shy of all-time highs, despite all this news and the fundamental sort of stories that have been coming out. We've seen the share price, the NASDAQ 100, push higher. We can see here that it's recovered off the 50 SMA really nicely. That's really been holding support, that dynamic support. We've got that long lower wick here. We've got quite a few long lower wicks on the move downwards, which suggests that there's little selling pressure at those lower levels. And then we've got the RSI above 50. So, this is an encouraging move. Just be wary of that candle that's forming today. Obviously, today it's still very early in US times, so one to be watching out for, but do watch for what happens around that all-time high level, 22,120. That's the level more or less that buyers are going to need to get above in order to create a higher high and to extend those gains. So just as far as what's going on in the US, let's just also take a quick look at what's been happening with the US dollar before we move on to what we'll be watching this week. So actually, we've seen some US dollar weakness, despite the fact that we've sort of had news of trade tariffs, and we've had that hotter than expected inflation. I think what this is really telling us is that the news as far as the Fed not cutting rates as much is very much being priced in now. So I think the dollar is waiting for its next catalyst. In order to go higher, it would need to have the market completely remove expectations of a rate cut this year, which hasn't happened. At the moment, with the markets pricing in about 1 rate cut this year. We're just at this sort of support resistance zone for the US dollar around this level here, actually, which is the 107 level. If we do break below that, then the next level I'm going to be looking out for is down here. It's this level here. It's around the lows that we saw around the 105.50 level, 105.60, the support zone there. If this level holds, then on the upside, you've got to get over that 50 SMA there at 108 in order to create a higher high at 108.50. But what are we going to be watching that might be able to propel those moves? Obviously, any further comments from Trump regarding regarding trade tariffs can move the market. But it's interesting because I do feel that we're not seeing as bigger swings when Trump talks about trade tariffs as we did on that first Monday when it was mentioned a couple of weeks ago, and we saw that massive sell-off. So we're not seeing that same sort of reaction. So it's almost as if the market's becoming a little bit numb to Trump's trade tariff talk. And it's sort of, you know, getting in on that idea that maybe this is just completely about negotiation rather than anything else. But as far as the US is concerned, it's quite a quiet start to the week. It's not until we sort of move to Wednesday where we've got the FOMC minutes, which will be watched closely. Now, with the FOMC minutes, I think the thing is we've heard from Federal Reserve Chair Jerome Powell this week. There are also going to be plenty of Fed speakers next week. So they'll be watched closely as well. But between the Fed speakers and the Federal Reserve Chair Jerome Powell's speech this week, it almost feels like the minutes to the January meeting may feel a little bit stale because we've had so much fresh information since. However, to be honest, the message I think so far remains pretty similar. There's not too much changing the message in the sense that the Fed is saying that it's in no rush to cut interest rates again anytime soon until the data suggests otherwise. Now, obviously, the inflation data we've had this week shows inflation is higher at 3%, so it's definitely not suggesting a rate cut is on the cards at all. And I think the meeting minutes will probably just reinforce that view that the Federal Reserve is very much in a wait and see mood now for the future until data shows it to be otherwise. So, I mean, the Fed is not really expected to cut rates in the first half of the year. It's the market's pricing in a 25% rate cut this year, but even that's not being fully priced in. So, I mean, the only way that we'd expect to see a big move, I think, from the FOMC minutes is if they were sufficiently hawkish to really see the market rein in the idea that the Fed will cut rates this year. And sort of, you know, remove that expectation to 0 rate cuts this year. So, but I don't necessarily think that that's going to be the case. So do watch out for those minutes, though, because they could add some color as well as the Fed speakers that we'll be getting through across the week. The other one to watch out for in the US is going to be the PMIs on Friday, and we've also got the Michigan Confidence Survey, which will be interesting because confidence in the US has been holding up pretty strong, but we have seen a recent easing in confidence, and given that household spending is such a key driver of the economy in the US, it does mean that that those figures can also be watched fairly closely because they can give us some clues about how the consumer is holding up and what we expect from that. So obviously we're having this meeting, this call today ahead of US retail sales, but US retail sales today are expected to contract 0.1% for the first time contraction since June last year. So could this be a sense that we're getting an idea that there's a little bit of a weakening seeping to the consumer? We will need to wait and see until next Friday, and obviously after today's retail sales data as well. So not so much a US-centric week next week, but it may be. Obviously, that depends very much on Trump. But we do have some other bits and pieces to be watching out for. First of all, we've got the RBA interest rate decision. Sorry, just whilst we're talking about the US dollar and what's happening in the US. I just want us to take a quick look at what's going on with the USD Japanese yen. This is because it's at quite a key level. We're just sort of testing that 200 SMA supports there. We've risen above it, recovering from that almost 150, 151 level, rallied up to the 50 SMA here at 150, around the 155, just below 155. And now we're back at the 200 SMA. RSA is tilted to the downside. We are obviously in this sort of period of lower lows and lower highs, although we have just seen actually a higher high there. So we've been seeing lower lows. So what will be interesting here is to see whether we actually see the interest rate differential between these two start to play out between the USD and the Japanese yen. Obviously, if we get that really hawkish FOMC meetings, which minute meetings, which I don't think we will, I think that's all been priced in what we're expecting to hear from that. So, you know, we might find that actually we have a bit more of a dollar drifting lower week unless there's sort of a massive catalyst to drive it higher. The other one just to watch as well, we've looked at the NASDAQ. Let's just have a look at the S&P 500. Again, very, very similar. Look, we're testing all-time highs, similar to the NASDAQ. We've got that 50 SMA, which has really been holding support nicely. Long lower wicks suggesting little demand, selling demand at those lower levels. So that's really an encouraging picture for that breakout. But we do need to see a rise above that 6,130 level for fresh all-time highs. RSA is also supportive. So, you know, there could be a case for record highs. I mean, I think if we do see slightly softer retail sales data this afternoon, then maybe that will help the boost those Fed rate cut expectations and lift the S&P 500 higher. But now let's just take a look at the RBA and what the Reserve Bank of Australia might be up to, because they do have their interest rate decision on Tuesday. This could potentially be the first rate cut from the RBA. They've been very late to the central bank easing cycle. This will be there because they lifted interest rates to a lower level than other central banks. However, I think it's worth pointing out that although the market is fully pricing in a 25 basis point cut, I think the decision could be more finely tuned than what the market is giving credit for, and therefore it's not a done deal. So I think there is a larger possibility that we do see a cut, but I wouldn't say it's 100%. I mean, we do have sort of wage pressures have eased by more than expected, which is, you know, encouraging for an RBA rate cut. We've obviously got inflation down to 2.4% in Q3, so that's slightly below the 2 to 3% target range that the RBA looks for. And that's going to provide them confidence to ease. The unemployment rate is still low, which could result in some uncertainty over the pace and the timing of the first cut. That's where I think the potential for it not to be a cut comes in. But basically, the market, as I said, it's pricing around 83 basis points worth of cuts across the year. I think it's interesting because the Bank of Canada, the RBA may need to cut further than it's planning, or that the market's giving it pricing in, if we see this sort of US protectionism role and trade tariffs against China ramping up, or should those trade tariffs, we've only seen 10% tariffs applied to China, but should they start impacting the economy later in the year, and sort of given that it was in a more fragile state to start with, then maybe we could see that weighing on the Aussie dollar going forward, but just not for now. Interestingly, we're seeing that the Aussie dollar is recovering from the lows that we saw sort of, you know, back in early February, and this is a a sort of dollar weakness story that we're seeing playing out here. We'll see a similar pattern across several of the other currencies, but this is the 50 SMA. We've risen above the 50 SMA. We're testing this really key level here, which is the 63.40. This is the low that we saw when 63.50, 63.40. This was the low that we saw back in August. It's also a level that we've seen in December and again in January. So if we get a rise above that, which momentum's on the side, so if we can rise above there, then we'll be looking at around 64.15, which is the 38.2% Fibonacci retracement level from the September 24 high to the low that we saw in February. So if we do have a retracement, that's what we'll be looking for on the upside. On the downside, the 50 SMA is a spot I'd be watching out for, 62.75. We'll see in a lot of the currency charts, and we've seen on the US indices as well, that the 50 SMA is proving to be quite important as we speak. But if we do see a rate cut from the RBA, but a cautious stance to further rate cuts, then that will obviously be beneficial for the Aussie dollar. That slightly sort of hawkish cut, if you like, may give more strength to the Aussie dollar, helping it higher, and particularly if we see any sort of a US drifting lower across next week, that could also help the Aussie dollar push higher. So that's great. Then if we just have a look here, we've got a lot of UK data coming out next week. So we've got a speech by Bank of England, David Bailey. We've also got unemployment on Tuesday. We've also got UK inflation on Wednesday, and then retail sales on Friday. So plenty of UK stuff to be watching for. Let's just pull up the chart. So just as far, look, there we go, we're talking about the 50 SMA. Just as far as the UK data and what to expect, it's, as I said, it's a very busy week for UK economic data. We've got attention, I think the most closely watched will be obviously on inflation. Now that eased to 2.5% in the December reading, with the service sector inflation actually dropping quite sharply from 5% to 4.4%. Now, these figures obviously gave the Bank of England confidence to cut interest rates at the February meeting. Interestingly, though, at the February meeting, the central bank warned of a tick higher in inflation across the year, which is expected to peak in Q3 at 3.8%. So we're expected to see a higher rise in inflation, and that's amid higher energy prices. And if we see companies passing on the higher tax burden, which could come about as a result of the labour market, the Labour government's budget, which put increased tax burden on employers. So if those increased costs do get passed on to the consumer, then obviously that could also lift inflation as well. So as far as what to expect, we could see a little bit of a tick higher in inflation, but I think that is to be expected. And even though it is to be expected now, the Bank of England still sort of seem set on cutting interest rates owing to concerns about the growth outlook. As far as jobs is concerned, the unemployment rate, let's not forget that it rose to 4.4% in the 3 months to November, so that was up from 4.3%. Industry data is showing that companies are really paring back job postings and doing so at the steepest pace since 2020. So this is also resulting in an increase of companies turning to redundancies. So there is some suggestions that we might see some weakness with regards to the UK labour market outlook, which might suggest that when we do see weakness in the labour market outlook, then obviously that does support the view that the Bank of England may be cutting interest rates. On the other hand, though, if we do see strong wage growth, and we are seeing wage growth remain relatively sticky, that could actually feed through to higher service sector inflation expectations. So Lots to be watching out for next week as far as UK data is concerned. If we do, for example, get hotter than expected inflation as well as rising wage growth, then we could see that really support the pound higher. The pound is looking to break above the 126 level. If we do get a break above the 126 level, that's going to bring the 200 SMA at 128 into focus as the next target on the upside. You know, there's quite an encouraging sort of momentum. We've got that bullish engulfing candle. We've got the RSI above 50, break above the 50 SMA. So there is some encouraging signs to this if we can get above the 126 level. As far as support is concerned, that 125 and also the 50 SMA there at the 124 sort of 80 level, they're going to be immediate support levels to be watching. If we get a break below there, then be watching out for the 123.50 zone. Okay, so just bear with me. The other thing I think, sorry, just before we continue, we've got, let's have a look here. Sorry, my computer's just getting a bit stuck. There we go. As far as what we'll be watching on the Eurozone side of things, we've got the PMI data to be watching for. Now, interestingly, we had the composite PMI was upwardly revised in February to just over expansion at 50. The level 50 separates expansion from contraction. So that's still showing very weak, stagnant growth. I mean, there's no two ways about that. So I think it's fair to say that the outlook as far as the Eurozone economy is concerned is pretty stagnant. Even so, we've still got the euro, the euro recovering. I think the recovery in the euro, again, it's a narrative surrounding a weaker dollar as well. And also there's a little bit of hope that maybe these trade tariffs which will be applied may be tools for negotiation. But I think, you know, if there are trade tariffs that are applied to the Eurozone, that could create quite a lot of trouble for the region. As far as growth is concerned, given that growth is already very stagnant. Just as far as levels to be watching, if we get some solid PMI numbers, if there are any signs of recovery continuing, then that could help the euro towards the 105 level here, the 105.30. Again, we've broken above that 50 SMA, which is at the 104 level. We've got the RSI above 50. So yeah, if we can look to push above 105, that's the resistance line. We need above 105.30 to create a higher high, and that will open the door to 106. Weaker than expected PMI data, so obviously that could have a negative impact on the euro, particularly if we also see a strengthening of the US dollar, or if there are any talks about, you know, more tariffs on the Eurozone. Then that could also have a negative impact. And yeah, on the downside, it's the 104 for the 50 SMA in focus as support ahead of 103.50. Just going to bring up the DAX because I think the DAX is a really interesting one in the sense that we've been seeing some really, look at that for a chart. I mean, off it goes. We've seen this incredible rally in the DAX. Even though there are those concerns over Trump applying trade tariffs, we're actually finding that the DAX is pushing higher, boosted by expectations that the ECB is going to continue cutting interest rates, which is obviously supportive for stocks, and that's helped them gain ground. We're very overbought though, so just be careful of the overbought territories. That does mean we can expect to see some consolidation or even a move lower, but you know, as long as the price remains above the 21,000 level, then I think the bullish picture you know, does stay intact. On the upside, 23,000 is going to be the next logical level. Just with talk about sort of, you know, all that's been going on with trade tariffs, the Fed, etc. Definitely worth having a look at gold. Again, overbought on multiple time frames. So yeah, just be wary about going long at these levels. That's not to say that the bullish picture isn't still in play, it is, but we might see a bit of a pullback But as far as demand for gold remains, I think the fundamentals are there. We've still got central banks buying. We've still got sort of those geopolitical risks, although news of, potential peace talks in Ukraine could lower those geopolitical risks. I think they could still build elsewhere because of trade tariff wars. So that's driving and boosting safe haven demand. Obviously, we've got the weakening of the US dollar, which has helped as well. But interestingly, gold has powered higher, even when the dollar was rising and even when the dollar's falling. It doesn't seem to be paying too much attention to that. But obviously, we do have higher inflation in the US. And so this is a hedge against inflation as well. And that's also helping the precious metal push higher. 3,000, that's the big level that everybody's looking for. But obviously, as I said, be wary of this overbought territory. A couple of levels to be watching for. I think you've got this one here around the 2881, 2,880, 2,885 around there. You've also got then the 2,850 as a round number. And then it's not until we get to here, which is 2,790, that we need a fall below that in order to negate that near-term uptrend. And finally, let's have a look at oil. Oil's, so it's quite a messy chart. I mean, it's still below the 200 SMA, but as far as oil is concerned, obviously we've had the concerns about trade tariffs and what that might mean for global growth. We've also seen higher than expected US inventories, and these have all weighed on oil this year. We've also seen, just trying to think what else we've seen, the EIA have just lowered their demand outlook slightly. So there's lots of things that's going on in oil as far as, but there is still very much a wait and see mood, I think, just to see what's happening as far as trade tariffs are concerned, what that means for global growth. Obviously, oil production in the US is also expected to be increasing, which could keep some pressure on the price. We're just caught between this really familiar 71.50 to 72.50 range. That's where we've been for quite some time. I just think on the 4-hour chart, this does seem to show itself a little bit better. It's a little bit less messy. We can see we've been in this sort of downward trend since the middle of January. Failure at the 200 SMA, a retest here of the $70 a barrel, but we're sort of looking to recover. I mean, what happens now depends very much on where we go from above that 50 SMA. If we can get above that 50 SMA, that's going to bring the 200 SMA back into focus, possibly even 75. Maybe we get a retest here. It's quite neutral at the moment. If we get a retest of 70 and we get a break below there, then we could be looking for a decline towards the 68.50. So that is everything from me. It's gone extremely quickly, and we did we quite get through anything? The other, oh no, we do have one more thing that I'm going to go through actually, which is the Bank of Canada's inflation data. Inflation in Canada has been relatively weak. They've been cutting interest rates on a regular basis. The CPI fell to 1.8% in December, so that was below the 1.9 that was forecast. And also the minutes of the latest Bank of Canada meeting, which were released this week, showed that policymakers are sort of recognising that there's a looming threat of potential revival in inflation on the back of tit-for-tat trade tariffs with the US and Canada. So, I mean, they're very much in a wait-and-see mood again to see what happens. Obviously, those tariffs have been put on pause for 30 days. Trump did apply them and then said that they're going on pause. So we're still sort of waiting to see if that can be negotiated. This is the US dollar loonie. So we are actually seeing sort of, those fears over trade war sort of ease. That's helped strengthen the loonies. Loonies falling down to around that 142 level, which it's testing. Bearish engulfing candle is quite interesting and sort of is suggesting that there's quite a lot of selling pressure. Next level on the downside we're looking for is 41, which is also the 141, which is also the 100 SMA. And if we get slightly hotter than expected inflation, on the upside, if we do get weaker than expected inflation, that's going to fuel further Bank of Canada rate cuts, and the Bank of Canada have been cutting 6 times. I think they've cut rates ahead of most other central banks. Then this will be a level then to be watching out for on the upside, 143.10. Okay, so if we see a recovery into that, that gets back into this trading pattern, this holding pattern, which we've been trading in since mid-December. So that is now everything. And then thank you very much for joining me, and I look forward to seeing you again next week.